Hello, everyone. Good evening. We will be starting here in just about 2 minutes. Got a lot of you signing on. That's exciting. All right, everyone. I know there's more of you that are still joining, but I wanted to go ahead and get us started. I do have everyone muted this evening. You can unmute yourself later. There is going to be time at the end of the presentation for us to do a Q&A with Marla, our wonderful guest presenter. But I wanted to start us off kind of with why we're here. I'm Nick Liebert from EXIT Strategy Realty, and on behalf of all of us at the office, thank you for joining our consumer education series. This is our second of 3 presentations we're doing to you on these Money Mondays at the end of every month to get you ready to purchase property in 2021. I think we're all ready to say goodbye to 2020. And so we want to get you in the right mindset for purchasing in 2021. My personal feeling is that 2021 and into 2022 are going to be pivotal moments for you to be changing your entire financial future. And the reason why I feel that way is that these interest rates are at historic lows. We have more properties coming on the market. We're seeing some price reductions, some of them substantial. So we know that there is a potential with more buying power than ever before for you to get into a position to either buy your first property, upgrade, or what a lot of us on this line are doing. We are trying to build wealth for our future, create a legacy for ourselves, leverage other people's money, the bank's money, in order to purchase property. You can see behind me, I've got my income and expense board, my income streams. I'm very passionate about making sure all of our real estate agents at EXIT have the opportunity to earn multiple income streams. And for you, the consumer, that you have the ability to also not just buy a home and do what we call mattress money, which is where you are purchasing a property and over time, just by paying down on the mortgage and hopefully seeing some appreciation, you're basically putting money in your mattress because you're sleeping there. It's your primary residence. But beyond that, that you're getting what we call mailbox money, that you are physically able to create multiple income streams for yourself beyond your regular job. A lot of us have read the book Rich Dad, Poor Dad, and we know that there are the abilities out there to not just work a 9-to-5, but really create a legacy and a financial impact on your entire family, maybe even a charitable organization. Whatever your future holds, the next 12, 18, maybe 24 months are going to be pivotal because of these record low interest rates. So I have a guest speaker tonight that I think can articulate the value of a rehab loan, a renovation loan for you in a much better way than I can. I have been working with her for years. Marla and I have actually worked together for over a decade now, and she is an absolute expert in the category of rehab loans. We're both very passionate about helping you create income for your future. And there's nothing like a rehab loan product out there in terms of getting you into a property that may need some work, whether it's a primary residence, whether it's going to be an investment property. So we know there's people of all types on this webinar tonight. I'm seeing a lot more people logging in. That's fantastic. This session will be recorded. It will be sent on to our EXIT Realty agents to distribute to you so that if you miss a portion of it, or you have a friend that you want to show it to, a family member, a partner in your dreams for the future, that you can send it to them. What we love about rehab loans is it can get you into that property. It can also wrap in the renovation costs, because we know a lot of the properties that are coming on the market, they need some work. There are things in there that you're going to want to change, adjust, add. And if you can get into a property at these record low interest rates with the borrowing power you have, and also potentially turn that property into something that you can create and make more income off of because of the improvements that you finance through the loan, that is just absolutely incredible. So think of it, if you have the money to put down, but you see a property that needs work and you don't have the money to put into the property out of your bank account or a savings account, this is an opportunity for you to greatly increase the types of property that you can look at, the condition of the property that you can look at, and it gives you a tremendous amount of added opportunity. And that's what we're here at EXIT to help you do. So without further ado, I'm going to introduce my friend Marla from Cross Country Mortgage. They have done a wonderful job for us for many years. She and I have personally done renovation loans for a lot of my clients. Some of you are on the line tonight. So I'm going to turn it over to her. I'm going to make her the host of the meeting, and she is going to be sharing a lot of information with you. So give me a moment to do that.
Can you hear me now?
Yes, we can.
Can you see me? I still see you.
We don't want to see me. We want to see you.
I don't see me. Do you see me?
I do not yet. Let's see. I see. Yeah,
oh,
there you go.
There we go.
All right. I'm going to turn myself off so we can only see you.
Okay, perfect. Hi, guys. Thanks for joining us tonight. Let me try to get my slideshow started so we can jump right into the topic. So share screen. So I guess I am sharing screen 2. Okay, can you guys see that?
Yes, ma'am.
Yes.
Okay.
Yes.
Perfect. Okay. So as Nick mentioned, tonight we're talking about rehab loans, which both he and I are very passionate about. We both have done rehabs ourselves. We both firmly believe that it's an important part of building your wealth. I think that the strategies that are being pushed today for retirement, as far as investing in a 401, sorry about that, investing in a 401k and that being your primary and only source of retirement is dangerous. And I think it's going to lead to a lot of people not achieving the goals that they're expecting. A lot of people don't realize, just a short tangent, that 401ks that whole strategy is only a few decades old. So really we're the guinea pigs for it. It's not a proven strategy. Everyone had pensions before that. So this, having renovation loans is a great piece of your renovation or your retirement strategy, where you can have multiple streams of income, and not just retirement. If you set it up right, it can help you while you're living as well, or while you're, sorry, scratch that. Of course, you're not dead when you're retired. Okay, sorry. Let's start over. So investing in real estate can help build wealth while you're still working as well. But it certainly could be a good piece of your retirement strategy to help supplement 401ks, Social Security, anything else that you're working on. So we're going to talk about how rehab loans are an important part of investing. And I know on the call, we have a mix of real estate agents, real estate investors, and regular home buyers and homeowners. So I tried to mix up the content so it applies to everyone. There are some pieces that will apply to different people, and we'll just try to keep it going. If you guys have questions, feel free to jump in. So brief intro, like Nick mentioned, I've been in the mortgage industry probably 16 years now. Nick and I have been working together for at least a dozen of those. On top of that, I also invest in real estate. I bought my first property in 2007. I've done some flips. I have some properties that I hold and rent. So having the personal experience with renovation loans myself definitely helps me when I'm working with clients who are building portfolios and doing renovation loans, more than just a textbook knowledge of the loan, but really understanding what you're dealing with out there in the properties with contractors and tenants, and then also looking at the big picture of how does this really fit into your overall financial strategies and planning, not just as a one-off transaction. So that's a brief introduction of me. We are also tonight going to talk about when to use renovation loans, key features of renovation loans, what is the process to do a renovation loan, and what are the different loan options. So when to use renovation loans. So the first is a reactive situation where you're not intending to use a renovation loan, but you sort of accidentally fall upon it. So the first one is if you have an inspection go bad. You planned to buy a house with a regular loan, you had an inspection come back that needed some repairs, and the house was still, something that you or your client wanted, and you were able to work out the numbers that it still made sense to buy. So those we can include the inspection items and flip the loan to a renovation loan and save the deal that way. If your buyer is doing an FHA loan, there are health and safety requirements that the property must meet. And sometimes they don't meet those requirements. So the appraiser may come back and say, there's peeling paint, there's stairways without handrails, there is cracked cement in the backyard that's a tripping hazard, a number of issues that FHA considers health and safety issues that they don't let you buy the property with those. So that is another reason you can add those things into the loan. And again, keep a deal that you were not necessarily intending to be a renovation loan. Code violations, the biggest one we see in Chicago here is back porches. Oftentimes, back porches are not up to current code, and so the city will come out and start not ticketing people, but whatever, they write up the violations, and then when we pull title, it's actually a lien, and so it blocks you from getting a regular loan. But as long as those violations are resolved through the renovation loan, that is acceptable. You can move forward with those as well. Here's one of the common ones I see is when people are shopping in a certain neighborhood, but their budget is too low for the neighborhood. Let's say the average price point in the neighborhood is $250,000 and they're only qualified for $200,000 or $225,000. So of course if they're looking at the lower priced end of the neighborhood, it's going to be homes that are outdated or have deferred maintenance problems with them. So these are situations where you certainly could consider a renovation loan, even if that wasn't your initial intention. On the other side, again, with those being accidental situations, there are people who are intentionally seeking renovation loans, that we're actively looking for properties that need fixing up. And so some of the reasons for that is, one, if you just want to customize a property to your preferred taste, you want to pick your own cabinets and backsplash and counter and light fixtures, and you just want it to be to your own taste. So that's one reason. Another is if you've been shopping around and you're just not finding the perfect home. You find a lot of homes that are close, maybe the right location, the right size, but not quite what you want. You can customize it to make it into your perfect home rather than waiting for your perfect home to come on the market if it's not already available. Some people like to buy fixer-uppers to create value. So if they are intentionally buying it way below value, and they know that even after they add the rehab, they'll be increasing the value beyond what they're spending, then you get a little bit of profit in the deal. And so that is a nice payday, and that's, some people intentionally purchase renovation fixer-uppers for that reason. Some people like to invest in the neighborhood. If there's a lot of troubled homes in the neighborhood that are distressed, it's a good way to bring the neighborhood up by fixing them up, reselling them at a higher price, and it brings the values of all the homes in the neighborhood up and increases the quality of the neighborhood. Sometimes people who own homes already want to do a renovation loan to improve their current home. And so renovation loans are available for refinances as well. So if your home is just outdated, but everything else as far as the location and the size still works for you, you just want to update it to more modern standards, you can certainly do that. If you have some deferred maintenance that you need to help to pay for to address that. if your home needs, even if it needs major repairs, let's say you need to replace the whole roof or you're tuck pointing larger projects, all of that is fine to be included. And here's one we're seeing a lot lately is people who want to expand their home, but they don't necessarily want to move. So they can either, finish the basement so they have additional living space or recreation room, bedrooms down there, finish an attic, add a second floor to a house, do an addition on the back of the house. I've seen all sorts of variations to increase the size of your existing house. So renovations with refinance loans are perfectly acceptable too. And we definitely have quite a few of those, especially now a lot of people are looking for a little more space. Okay, when to use renovation loans. So again, homes that have deferred maintenance we talked about. Right now, I'm not seeing a lot of foreclosures, short sales, other sort of distress sales. I have seen some estate sales, but not too much in the area of distress sales. But if the market shifts and there are more opportunities for foreclosures or short sales, those tend to be just by the nature of the situation in a little bit of distress. Initially, because obviously if someone couldn't afford to keep their house, they probably couldn't afford to maintain it well. And then after it's foreclosed, sometimes they sit vacant and then there's vandalism. And so then they're sometimes even more distressed. So if the market ever turns that there's more opportunities for those, that could be something to look at. Lately, I've also been seeing, well, not lately, I saw this before too, when people want to change the property type, the main thing I see is people buying 2-unit buildings and then deconverting it to a single family house. And there's a number of reasons for that, but in some neighborhoods, a single family house is worth more than a 2-unit building. The values are just higher. And so, sometimes it's less expensive to buy the 2-flat and turn it into the single family than to buy a single family. So I've definitely had a good number of clients do that and had good results with that. Renovation loans can be used to address illegal units. We know that's very common in Chicago. I would say maybe even half of the multi-unit buildings have illegal basement units. So if it can't be converted to a legal unit, you could just make it into a finished basement. You could do a duplex down with the first floor unit. There's a lot of things you can do to make it within the guidelines and just make minor adjustments if it's already finished. Okay, so if you are a real estate agent and you're trying to sell a fixer-upper, it can be a little bit difficult to attract buyers because a lot of buyers want a house that's already in good shape. So when you're selling it, you want to be clear in the listing comments what the opportunity is. I think when you try to put lipstick on the pig and make it sound like it's a great house, then buyers show up and then they're disappointed. So if you clearly start out by saying this is a home with great bones, great opportunity, customize it to your own taste, and you're letting the buyer know that it's an opportunity to improve the home, you attract the right buyers who are open to that opportunity. You can specifically say rehab financing available and list the phone number of a loan officer that does rehab financing. You can include educational material, brochures, and flyers in the listing. One thing I've seen people do, which has been really successful, is the listing agent will actually have a contractor give a proposal for the renovation or a HUD consultant do a feasibility study and provide that to the new buyers. So they don't have to wonder as much. They may come in and say, okay, I see I could improve it, but I have no clue how much that would cost or what it could look like. So if you show them, all right, here's a proposal to do a complete renovation on the kitchen, knock down the wall from the kitchen to the dining room to make an open floor plan, whatever you're proposing, and the contractor already has it laid out, oh, this would cost $60,000, and then we can do an estimate of what that would be with the purchase price, the monthly payment. Then the buyer can have more imagination to see what it could look like because you're showing them that option rather than them having to figure out in their head what that could look like. And then sometimes I've also seen people do like before pictures and then after renderings. I know there's a lot of technology now. I don't know the name of it. I haven't used it, but several software programs that allow you to manipulate what the property looks like. So you could use one of these renderings to show what the property would look like after it's repaired. And that would allow the buyers or prospective buyers to have more vision of what could be done with the house, because as we know, a lot of prospective buyers come into the house and they have a hard time seeing what the house could look like renovated. They just see what it currently looks like, and they know that's not what they want. So by, as the listing agent, giving people a very easy system to see exactly what could happen, what it would cost, what the monthly payment would be, and lay it out in front of them, it could help sell homes and attract the right buyers who are willing to take on a project like that. Okay, so there's 3 types of repairs. There are required repairs, and these are, health and safety issues. If you've got mold or, anything that could be a health and safety issue. There's recommended repairs, which, it's not a health and safety issue. It's not dire, but it is strongly recommended. And then there are optional remodeling, and that's anything you want to do. There is very little limits to what you could do for your optional remodeling. So obviously the required repairs have to be done. And some people who just want to do the bare minimum will do just the required repairs. Other people, will want to include as much as they can in the loan. And some of that is a factor of like your budget or, other factors that we would look at to see what you can include. Types of properties. This can work for owner occupied. If you're going to live in the home, you can renovate it for yourself. If you're an investor, there are some options for that as well, where you can buy the house and fix it up. And we'll go through that in a little more detail. So both owner occupied and investor deals, you can do single family houses, you can do condos, you can do townhomes. Owner occupied, if you're going to live in it, you can also do 2 to 4 unit buildings, which we do not right now have a 2 to 4 unit building renovation option for investors. So that is available owner occupied, but not as an investor. And then mixed use buildings. So if it's got commercial space on the first floor and apartments upstairs, that also works for owner occupied as long as they're going to live in one of the apartments. So, so a lot of options for property types. I don't have the chat open, but I think you guys can unmute. So if anyone has a question, feel free to jump in and unmute. Otherwise, I'm not going to see questions. Other features about renovation loans. So it is one single loan. It's not a loan to purchase the property and a separate loan to renovate the property. It's one loan that includes the purchase and the renovation money, and it is fixed for 30 years. So a lot of people will refinance after the renovation is done just to get the lower interest rate of the non-renovation loans. But if you did keep this loan for, for as long as you own the property, there's no consequence of that. It is a fixed rate loan, 30 years. There is not a balloon payment. It's not a temporary construction loan. You can keep it. The interest rate is locked, and the monthly payment, the mortgage part of the monthly payment is fixed. So from that sense, it's very easy. Go ahead.
Hey, Marla, it's Cassandra. I'm sorry.
Miss Cass.
Hey, hon. I have a quick question. So when a client is wanting to finance out of that, what is the minimum threshold that they have to keep that loan before they
Oh, as far as the time frame?
Yes.
So there isn't technically a restriction for the client. There's nothing in the documents the client says that you have to keep this loan for, 3 months, 6 months. There's no requirement. But what actually happens to the loan officer and the lender is if you close a loan in a shorter period of time than 6 months, we actually get all the profit that we made on the deal, including the loan officer's commission, taken back. So, if you want to maintain a good relationship with your loan officer, it's nice if you keep it open for 6 months, but there's no penalty to the client if they do close it earlier.
Okay, thank you for clarifying.
Sure. Yeah, and like I said, a lot of people do end up refinancing out of it. Well, actually, a couple reasons. One, to get the lower rate of the non-renovation loans, assuming the market still has lower rates and they haven't gone up a lot in the meantime, but also because if you've now improved the value, you have more equity. So if you had PMI, you could maybe reduce that or get rid of it. So that's another reason people often look to refinance afterwards. Renovation loans have low down payments, just like other loans. There's 3%, 3.5%, 5%. We'll go through that a little bit later. Seller credits are allowable to help pay for your settlement costs, so no additional restrictions on that. It allows you to buy the property in current condition, what they call as is. So you can avoid asking the seller to complete repairs, because sometimes the seller won't do that, or that'll kill the deal. And it is okay if the utilities are off. That's not such a big deal now. I haven't seen a lot of that, but on foreclosures, that's pretty common that the utilities are off. They do that so the pipes don't burst, in the winter, things like that. So, and a lot of times with foreclosures, they won't turn them on for you to test them. So that can sometimes be a problem, but with renovation loans, it's not a problem. It's fine, because we just work in a little extra money in case there's problems with the utilities we cannot test. And what was I saying here? Oh, I know. So if you're not doing a renovation loan and the property doesn't pass the standards required for health and safety, then the loan could get denied. So this would give you a higher level of certainty that the loan would get approved. Sorry, I've been talking all day. I was doing other trainings earlier, so I'm dehydrated. Okay, total acquisition cost. So this is a term that refers to the total of the purchase and the renovation budget together. So first we have the purchase price. Then we have what's called the hard renovation costs. So hard renovation costs include labor and materials. So basically, this is what you're paying your contractor. Your contractor comes out and writes a proposal, for replacing the kitchen cabinets and counters. And so he's got the materials for the counters, the materials for the cabinets, and the labor you have to pay him and his workers to actually install them. So a lot of people think renovation cost is just labor and materials, but those are what we call hard renovation costs. Then there are the soft costs. So these are not directly for the renovation, but they are additional costs that have to be factored in. So the first one is HUD consultant. If your renovation is a larger project, so typically more than about $30,000, or if there's any structural work, you do need to have a HUD consultant. So this is a person that helps navigate the process. They help you structure the renovation to make sure everything is included. They help review your contractor's bid to make sure that the price is reasonable. And then during the renovation, they also help you do the inspections to make sure everything is staying on track. So they follow through the whole process. So there are some fees for their services. Inspections, during the renovation phase, we do inspections. And that is to make sure that the project is again moving along as it was planned and the work is being done as agreed. And after each inspection is when the contractor gets a draw or a payment released. They have to pass that inspection in order to get their draw. Permits, depending on the type of work you're doing, you may have permits from the city, and most cities have some type of permit, whether it's Chicago or any of the suburbs or any other areas. They're different dollar amounts and they're different categories, what they're broken into, but most projects have some sort of permits. Architects are needed on some projects, not others. Obviously, if you're knocking down walls, doing additions, changing layout, you will need some kind of architect drawings. Contingency reserve. What this is basically an extra fund just in case the project runs over. And for anyone who's done renovation projects, you basically are pretty much guaranteed that it's 95% likely that something will run over, because we don't have x-ray vision. So it's not like when we are looking at a property, we can see through the walls and we know everything that's wrong up front. So we do as much of an inspection as we can. We try to figure out everything that needs to be done. But inevitably, if you're, opening up a wall or, doing some work, it's likely you may find something additional that you hadn't planned on. And that's going to cost extra money. So basically, we plan that in because we know there's a high likelihood that would happen. If you don't end up using the money, we give it back to you. But if you need it, you'll be glad that it was there and you didn't have to, struggle to come up with another way to come up with extra money. Finance mortgage payments. This is a very nice feature. It only applies if you're going to live in the property. It does not work if you're an investor. But basically what this means is during the renovation phase, we can include mortgage payments in the loan. So you don't have to personally pay those mortgage payments as the renovation is going on. And the reason for that is because typically if you're not living in the property yet, you're still paying rent or mortgage somewhere else. So we haven't qualified you to be able to cover your current rent and the new mortgage. So we don't want you to have to overlap both of those. So we basically roll the mortgage payments in. So it's not that there aren't payments. There are payments. They're just added to the loan and paid for out of the loan. So you don't have to pay them yourself out of your own pocket. Supplemental origination fee. This is basically an administrative fee for the renovation phase. So basically, if you, everything you have to do, you have to order the inspection, they have to cut the draw check. If there is a change order, if something unexpected comes up, when you're ready to close out, they have to handle the lien waivers. There are title updates every time you do a draw. If you end up changing contractors, there's paperwork with that. So basically, this handles all the administrative fees that are related to the loan. And all of the costs for these soft renovation costs, we actually roll in the loan, because once you close, we don't want you spending any money out of pocket. We want everything factored in so we know there's enough money for you to successfully complete your project. So all of those costs will be rolled in, the hard costs, the soft costs, the purchase price, and then you'll basically just be paying your down payment. And oh, one last thing is title update fees. I did mention that as we do draws, we update the title to show how much money you've actually drawn on the mortgage. Okay, no other questions? It's very weird not seeing you guys. Okay, so let's do an example. So we're going to do two examples. One is a smaller project, one is a larger project. So a smaller project, it used to be called a streamline renovation loan, and now they call it a limited renovation loan. So here's a sample budget. So again, the hard costs are labor and materials. So let's say if it's only $30,000, and again, it cannot have anything structural. So you can't be, like building a deck or knocking down walls or anything with this. So $30,000 and nothing structural. Then we have our soft costs. So with the streamline or limited renovation loans, there are no HUD consultants. So there's no fee for that. In this case, you just deal directly with the contractor. The contractor writes up the proposal for the work, also sometimes called a bid, and then we just go off that. No HUD consultant there. On the smaller projects, there's only one inspection. The contractor does all of the work. Then there's one inspection at the end and it's done. There aren't periodic inspections throughout. So that's typically between $150, $250, depending on different factors. Permits, in some cases, if it's a small job, there may not be any permits required. In some cases, just like a general building permit. So I believe in Chicago, the general building permit is still only $500. Some of the suburbs are different. Now, if you're doing something specific like electrical, plumbing, you may need some different permits. Architect, again, we're not going to need an architect on a smaller projects. We're not doing anything structural or major layouts. Okay, contingency reserve. So the contingency reserve can be between 10 to 15% of the labor and materials costs. And the way it's factored in, we determine it, well, really, yeah, I guess on a streamline, we determine it. On the larger ones, the HUD consultant determines how much is needed, but there's a lot of factors based on the scope of the work. Are you doing the type of work that's likely to have, a lot of unexpected things come up? Or are you doing something that's really straightforward and easy? Are the utilities on or off? And the reason that's a question, because if they're off, we don't know. There might be plumbing problems or electric problems or something that we can't test because the utilities are not on. So then we would want a higher contingency reserve to compensate for that. So it's typically 10% to 15%, sometimes as high as 20%. And in some cases, actually, it can be a little lower on an exception. I've had some where we did 5%. I actually had one where we got 0%. And that was an exception. And the reason we got the exception is because the guy had like $50,000 in the bank. So we knew if he overran, he could cover it himself and he wouldn't be strapped. And we just needed the money in the deal to make the numbers work. So that can be variable. So here I did in this example, 10%. So $3,000 is 10% of $30,000. And that'll be our contingency reserve. Again, if you don't end up using it, you get that money back at the end. Finance mortgage payments. We don't do finance mortgage payments with the smaller renovation loans because we assume it's going to be done quickly and you're going to be moved in probably around the time of your first payment. So we don't expect these to drag on. So there's no mortgage payments in there. And then the supplemental origination fees are smaller on these because there isn't as much paperwork. There's only one inspection, one title update, one lien waiver, and they just close it out. So it's not as much work. And then the one title update. So in this example, the total renovation budget is a little over $34,000. Whereas the labor and materials was $30,000. So this is where a lot of people don't know to factor in all these extra costs. They think, oh, the contractor said it's $30,000, so the renovation is $30,000. And we really do have to factor in all these costs. So even on a smaller project, it's still a little over $4,000 we have to take into account. So let's do a sample for a larger project. So obviously, if the renovation is larger, all the costs associated with it are larger. So in this example, if we're doing labor and materials of $150,000, obviously it's a bigger project. We're going to have a HUD consultant involved. The HUD consultant fees are based on the project. Smaller projects have smaller fees, larger projects have larger fees. So I estimated $1,500 for this project. Inspections, the number of inspections depends on how big the project is. So renovation loans are allowed to go up to 6 months. So if this were the maximum, a 6-month project, we would have 5 inspections, and inspections are typically, like I said, between 150 and 250. So in this case, I estimated 250 for 5 inspections is 1250. And again, remember, even though the inspections happen after closing, we're rolling all this money in. So you won't have any cost. When you're doing the renovation, nobody's going to ask you for a check for those inspections, or everything is prepaid and set up and ready to go. Permits, assuming it's a larger project, you'll probably have some extra permits, electrical, plumbing, you know, what have you. I think 3,000 is sort of typical for the city. Some of the suburbs are actually higher. I had one in Evanston that I remember was pretty high. I can't remember exactly how much it was, but definitely something you should check up front is what the cities are. And actually, as a side note, speaking of the cities, some cities have their own inspection process when you buy or sell real estate. And so sometimes they have additional requirements of their own codes and things you have to do for the property. And you can roll all those in the loan as well. Okay, so in this case, I was assuming no architect. We're not changing any layout. We're just updating, you know, what's there. We might be doing kitchen, bathrooms, flooring, painting, roofing, tuck pointing. None of that requires an architect. So in this case, we did not include an architect. Contingency reserve. So this again is a percentage of the labor and materials. So here I've estimated 10% of the labor and materials at $15,000. And then financed mortgage payments. So in this example, the monthly payment was $3,000, which is based on, that includes the purchase price, which I don't have on here. So in this, again, hypothetical example, if the monthly payment is $3,000 and we're projecting the project will take 6 months, that's $18,000. So we put that money in there. Every time the payment comes due, it's paid out of your loan. So you won't have to make those payments, but they are, again, added in there. So it's increases your loan amount and you do pay it over time. Supplemental origination fee, again, going to be a little higher because it's a bigger project. There's more administrative work for the inspections and draws and title updates. And then you have your title update fees. Every time they do a draw, they also do a title update to show the additional loan balance of how much you've actually drawn. So in this example, our total renovation budget is almost $191,000. So you can see compared to the labor and materials costs, we're actually adding about $41,000 of soft costs. So again, just to make sure you're taking that into account when you're looking at deals, that we need this extra room to cover all of that. All right, everyone with me? If you guys were live, I would ask for some thumbs ups, but I can't see any of you guys. So, okay, so let's talk about the renovation loan process. What are the actual steps you need to go through to get a renovation? Oh, I see a thumbs up. I didn't know you could do that. That's cool. Let's talk about the actual process you need to go. So step 1, a lot of this process is similar to getting a regular mortgage. We're just integrating the renovation pieces. So step 1 is a pre-approval, like any loan, but it's going to be a little different than a regular loan. The basic qualifications are the same. So as far as the minimum credit scores, the maximum debt to income ratios, the rules about whether you have bankruptcies, all of that is the same as a regular mortgage. So if you're already qualified for a regular mortgage, you will also qualify for a renovation loan. It's just a matter of how the numbers work out. So basically, in a regular purchase, you get a target purchase price. So let's say your target purchase price is $250,000 for a house in good shape. With a renovation loan, you're looking at a target acquisition cost. So that same $250,000 that would be just the purchase price now needs to cover the purchase cost and the hard renovation costs and soft renovation costs. All of that rolled in has to be factored in. So one thing that I will do is I'll give a chart that looks like this. So basically, what I do is I break it down what your purchase price would need to be with different renovation budgets. And for this chart, what I do is I just focus on the labor and materials because I know most people won't know what those soft costs are or how to calculate them. So in the first one, if there's no renovation costs, you find a house in good shape, this hypothetical person qualified for a purchase price, a target purchase price of $355,000. But if they found a house that needed $30,000 of, again, just hard renovation costs, labor and materials, the target purchase price would drop to $320,000. Okay, so and so on and so forth. You can see the higher the renovation costs are, the lower the purchase price will need to be. So, so this is a simplified version of one way that I do the pre-approval. Depending on the situation, I have different methods I use. But if it's a simple single-family house in a very narrow location, if you're just looking in Chicago or just a single town, I'll usually give a chart like this. What happens is the more variables there are, the more that the numbers shift and it becomes more difficult. So for instance, when I deal with multi-unit buildings, I've actually moved to, instead of giving a chart like this, I've moved to giving the client and the real estate agent a custom worksheet because there's so many different variables. So with a multi-unit property, you have the rental income. How much is that? And of course, that's going to be different depending on the size of the unit. How many units? Is it 2 units? Is it 4 units? So the rental income, the property taxes, and the renovation budget. So because of all those factors, it's impossible for me to say, okay, you have a target purchase price of $300,000 because it's going to be different. If the rent is only $800 a month versus rent that's $3,000 a month, your numbers could be, easily $100,000 different for different properties and different scenarios. So it's very difficult when there's all those variables. So I've moved to, like I said, this method of giving custom worksheets where you get a spreadsheet that's specific to your situation, and it will tell you what is the monthly payment, what is the down payment, does the debt to income ratio work for your situation, does the self-sufficiency work, which I think I'll talk about self-sufficiency somewhere a little bit later in here, but basically the worksheet gives you yes or no answers to a handful of questions to see if the property would work. So you can yourself have some autonomy in weeding out which properties may work and which properties, aren't worth seeing. Okay, I finally figured out how to open the chat while this is open. So let me jump back to some questions real quick. Maximum number of total financed properties for underwriting. So I actually want to check because guidelines are often changing and I have not looked that up recently to see if that has changed. So let me get back to you on that one. An example of a small project. So yeah, you could do just a kitchen or a bathroom with a small project, but it really depends on the finishes. I mean, you could do a kitchen for $10,000, you could do a kitchen for $100,000. It depends how high end you're doing it. It could just be a bathroom. It could be some flooring. There's some nasty carpet that needs to come up and they want to refinish the hardwood floors under it. So it's really more, as long as the dollar amount is under 30,000, anything could fall into that small category. So the custom spreadsheets are customized to the client. primarily because one of the factors that is affected is the debt to income ratio. And so obviously everyone has different debt and income. So that I do on a custom basis per client. So basically I have a process where the client sets up a home buying consultation, does the application, submits the paperwork, and then I can generate that. Okay, a lot of people want worksheets. I mean, I guess I could take out the debt to income ratio part so that the general parts apply. So you guys could just have that, not specific, customized to a client. So let me think about if I can create that. I did not get to down payment yet. I'm getting to that. Okay, so I'm going to move the chat off to the side and jump back into the presentation, and then we can go back to some questions again later. Okay, so step one is your pre-approval. Now you're pre-approved. Step two is to identify feasible property. So how do you know if a property is going to work? Well, first of all, you use either the chart or the custom worksheet you got during the pre-approval. So you're going to kind of do that before you even physically see the property to see if the numbers are within the range of, what you're pre-approved for. Then you're going to assess the renovation needs for the property. So how are you going to do that? So one is you can kind of eyeball it yourself if you've done renovations and kind of gauge, okay, looking at this, I could see maybe it's going to be about $50,000, if you have an idea. If you've never done renovation, you probably don't have, that expertise yet. You can work with a realtor that does have that expertise. A lot of realtors have done renovations themselves or worked with a lot of investor clients. Sorry, there's this little fly bugging around. I don't know if you guys can see it, but it's annoying me. It's like Mike Pence during the debate. So, except he didn't shoo his away. Anyway, you can work with a realtor who's experienced with renovations so they can help you ballpark the fees or the renovation costs. Some people will invite a contractor out to just do a preliminary, very rough estimate in the beginning. You can get what's called a feasibility study. So HUD consultants, when you hire them, they do this very long report that's 30 to 50 pages long that breaks down the project in great detail, line by line, labor, materials, exact materials. Are you doing granite countertops or marble or formica? Like, it breaks it down in great detail. But what they have is this option called a feasibility study, which is a very small version of that. It's basically a 1 to 2 page summary of, here's the rough idea of the project. This is what we're going to do. It'll cost between 60 to 90,000. So it's very rough, but it gives you a preliminary idea just so you can see if the project might work. And so you can use one of these methods initially to see if the property might work. Now, right now, being a seller's market, it may be tough to get a contractor out or a HUD consultant to do a feasibility study because of the time sensitivity of getting offers in. And in some cases, you may not want to spend a lot of time and money until you know you have an option to buy the property. So some people will write the offer first based on just their best guess or the realtor's best guess. And then from there, do the due diligence of actually having your contractor out, have a feasibility study, and then decide if it doesn't work. You're still in your attorney review period, your inspection review period, you can back out if it doesn't work. So in a lot of cases, I would recommend kind of just doing your best guess, getting the offer in, then do your due diligence, knowing that you can always back out and get your earnest money back. If you have time, the property's been on the market forever, it's not hot, nobody else putting a bid, and you want to do the due diligence up front so you make sure your offer, is really reflective of how much renovation is needed, that's fine. That's between, the buyer and the realtor to make that decision. Most importantly, don't underestimate because that is like the main thing that I see is that people really think that renovation is cheap. People will call me and say, hey, I'm going to get a full gut rehab and it's only going to cost, $40,000. Like, some people just have no concept of how much these things cost. And so when you underestimate, all your numbers are off and the deal is definitely not going to work. So really trying to be realistic about what those costs are. And, again, you may not know in the beginning. So if you don't know, I would err on the side of overestimating to be cautious until you actually get the numbers. Okay, step 3 is we're going to assess the after repaired value. And in my opinion, this is the most important step because this is the step that determines if the whole deal is worthwhile or not. So the after repaired value is exactly what it says. What is the value of the property going to be after you fix it up? That's what we want to know. So we want to know that the price you're paying to buy it and renovate it is worth it. Okay. So similar to when, those of you who are realtors, you do CMAs, comparative market analysis, to determine the value of any home, whether it's a buyer you're representing or a seller you're representing. You want to know what the value of that home is. So the difference here is that your CMA, the comps you're going to select, are based on what this house is going to look like. So we're going to identify recently sold properties that look what this property is going to look like after the renovation is done. So of course, to do that, you have to have a good idea of what the renovation is going to look like. So you want to go in detail with the client about that, because the client may say renovation and you may think renovation. You may have two different ideas of what that means. The client may be thinking marble, everything marble bathroom, marble countertops, and you were thinking, sort of a lower end granite, and the cost differentials could be way off, and what it looks like could be way off. So you really want to discuss with the client, okay, when you say finishing the basement, are you thinking adding bedrooms or just one big rec room? Are you thinking of putting a bathroom in or not? And so really to break down what they're talking about. So when you're doing the CMAs, you pull the comps of the right houses that look like what this house is going to look like and are most similar to that. So obviously all comps should be recently sold, preferably within 3 months. If not, within 6 months is okay. In some cases, if there really, really aren't comps, an appraiser would go back to 12 months, but that would be a stretch. If there are recently sold homes, they're going to go off the most recent. So again, comparable to what the home is going to look like after it's repaired. So similar size, bedroom count, bathroom count, and if you haven't done a class on really assessing valuation, I would do it. I know I've seen Nick offer some. I know they have some at, Chicago Association of Realtors or other organizations. But, sometimes I just see some of these values that the realtors are looking at, and I kind of wonder if they really never took a class on this. I had one realtor just last week actually send me comps, and one of the comps was literally double the square foot. Like the subject property was 1,800 square feet, and the comp I think was like 3,600. And I kind of like looked at her side-eyed. I'm like, really? You think this is going to win an appraiser over? Like that's not what we're looking at. So you really do want the most similar comp, not just the highest price comp that you're hoping will be used, but really the ones that are actually the most similar. And especially in this case, because you don't want to do your clients a disservice where you're overestimating and then we get the appraisal in and the numbers are all off, because they've spent a lot of non-refundable money with their inspections, the HUD consultants, the appraisals, and they get that far down the road to find out that the numbers are off. It's going to put them in a bad position. So we really want to be like pretty realistic about what is actually comparable, and make sure you're looking at those details. We obviously want the property within a short distance. So obviously the closer, the better. In Chicago, obviously, 3 to 6 blocks is great. If you're out in the suburbs, sometimes it could be considered the same neighborhood and it's still 3 miles. So obviously there's a much wider, geographic area that's considered acceptable in more spread out areas. In the city, it's also not just the distance, but the actual specific neighborhood. There could be another property that's only 3 blocks away, but it crosses a neighborhood boundary, and that other neighborhood is much nicer. An appraiser's not going to really use that comp. So you should try to stick with what an appraiser would use. So again, it's realistic. So I've used, examples before, for instance, like, if your property's in Washington Park and the comp is in Beverly, I mean, they're neighboring neighborhoods, but 3 blocks, 4 blocks difference, it's night and day. An appraiser isn't going to use that. Or another example is South Shore and the Jackson Park Highlands. A property that's in the non-Jackson Park Highlands part of South Shore, they're not really going to use a comp in Jackson Park Highlands unless there really are no other comps. So just make sure you really know your neighborhoods block to block, and you're picking houses, neighborhoods, locations that are really considered similar value, and a buyer would consider them equally desirable. Sold in the last 3 to 6 months, we talked about that. And again, do not cherry pick. Like, both realtors and investors are terrible sometimes, not all of you guys. I'm not saying you're all terrible, but just really looking at like, okay, the top 3 highest priced properties that sold in the neighborhood, are these 3. So we're going to use those comps. You don't get to just pick which comps you want, you have to pick the comps that are actually the most similar. So are they the same size, the same count, bedroom counts, all that stuff we've talked about. So don't just cherry pick the highest price comps and assume that your house is going to be worth that. Okay, active listings. So a real comp is a sold listing, right? Because when it's sold, we know that's what the market value was. Someone was willing to pay that. An active listing, we don't know if someone's willing to pay that price. That's just what the seller is hoping to get, what they're asking for. But the reason I like to consider active listings is because that will show you the trends in the market and what the direction of the market is. If the active listings are all higher than what the past closings have been, chances are values are going up. If the active listings are the same or lower than what the closed comps are, chances are the market is going down. So the reason this is important is because of the time of the renovation. So we're projecting, especially, well, I guess depends on the situation, but especially if you're planning to resell the property, you want to know what is the house going to be worth at that time. So today's active comps are going to be the sold comps in 3 months, 6 months. So those are going to be your new comps that you have to deal with at that time. So if you're looking to project out in 6 months, you're going to sell the property or you're going to refinance the property and you want to know what those next comps are, that's what today's active listings are. They may not sell at list price, but it'll give you some gauge of the direction of the market, and what things look like. Okay. All right, so now we have done, step 1 was get pre-approved. Step 2 was identify if the property seems feasible. Step 3 was assess the after repaired value. So step 4, we're gonna determine the offer amount. So if we think the property is feasible, the after repaired value seems like it's gonna support the purchase price and renovation, we wanna determine how much we're gonna offer. So this is how we're gonna come to our maximum purchase price. So we're going to first start with the after repaired value. I told you that's the most important. We start with that and we back into what the purchase price is going to be. So we take the after repaired value and we subtract the total renovation costs, both the hard costs and the soft costs. Okay, so before I jump on to the next one, if you're planning to live in the property and you're not necessarily doing this to gain profit, you just want to have a nice home that you customize yourself, you don't care necessarily about having a lot of profit, this is sufficient. You take the after repaired value minus the total renovation costs, and that will be your maximum purchase price. So in this case, you're basically saying the total of the purchase price and the renovation will equal what the property is going to be worth. So you're basically buying the property for what it's worth. You're just customizing it and getting to do the renovation project yourself. If you're looking to make profit off this, we want to start with the same part of the formula. Start with your after repaired value, subtract the renovation budget. Then we also want to subtract the desired profit. If that's your goal is to make profit, we want to make sure that's factored in. And then we want to subtract other costs. This is where most people mess up. They don't factor this. If you watch, any of those TV shows where people are flipping houses, they really simplify that formula, and say, I sold it for this and the renovation was this, and so here's my profit. And they don't factor in all these other costs that really do exist. And so you definitely do not want to underestimate those. So you have holding costs. So any costs you're going to have during that period of time, your mortgage payments, your electric bill, your gas bill, if you need to pay for security on the property, if it's a condo, there's homeowners association dues. During that renovation phase, there are costs you'll have to pay, and you want to factor those in. You'll also have settlement costs for when you purchase the property. And then if you're planning to resell the property, you also have settlement costs when you sell the property. So you want to make sure to factor all of those in so you don't overpay for the property. So when you subtract all of these, you will come to what is your maximum purchase price you can pay and still meet your goals of getting the certain desired profit margin. And I'm actually putting together another training on this. It's not going to be available for a couple of months, but I want to break down more of this. So talk about investing, but it's not going to talk about how to find investment properties, but how to calculate the numbers to assess potential investment opportunities. So we'll be breaking that down at some point in the future. Okay, so here's an example. We have a house that we think the after repaired value is $200,000. So we are going to subtract, again, renovation. So in this case, we're thinking there's a $50,000 total renovation cost. So again, both hard and soft costs. So if you're just going to live in the property, you don't care about the profit, you don't want to pay more than $150,000. Your $150,000 purchase price plus your $50,000 renovation budget will mean you would have spent $200,000, and now it's worth $200,000. So you're breaking even. So that's fine. You've got a lovely house. You're happy with it. All is good. If you're an investor and you're looking to make profit out of it, here's where we want to add more steps. So we want to subtract your profit. So let's say you want to make $30,000 profit. And technically this is net profit except for taxation. So we're not factoring that in here. So again, this is kind of like broad strokes, not so much nitty gritty. So we'll take out our profit and we're going to subtract other costs. So all those holding costs, settlement costs to purchase it, settlement costs to sell it. If you're not a licensed realtor yourself, obviously you got to pay your realtor fees as part of that. All of that is factored in. So in this example, all those other costs are $20,000. So you subtract 200 from 50, from 30, from 20. In this case, your maximum purchase price would be $100,000 if you want this $50,000 or $30,000 profit margin. Any areas that you mess up your numbers is going to eat out of this profit margin. Let's say the after repaired value is only 180 instead of 200. You were thinking, you had a little bit of wishful thinking, 20,000. Well, guess what? Now your profit isn't 30, it's 10,000, right? Let's say the renovation costs actually were 60,000 instead of 50,000, because you underestimated that eats into your profit. So in order to get the profit you want, you need to really make sure that these other numbers are accurate and leaning on the conservative side. You want to lean on the worst case, not the best case scenario, because anyone who's done any sort of rehab projects, it doesn't always go best case. That's pretty rare. So being conservative about these numbers to make sure you're protected. Yes, it's just an Excel worksheet. Is everything on step 4 on the custom worksheet? No, what's on step 4 is what I'm putting together for the new investor training that I have not done yet. The custom worksheet does not include like the profit, the other costs, all of that kind of stuff. So yeah. Let's see how long this goes. Well, no, it's going to go too long. I was going to say, maybe I'll show you guys a sample of the worksheet. I'll just put together a worksheet that's not, I'll take out the debt to income ratio part. So you guys still have, it's calculating the monthly payment, the loan amount, and some of the other factors. So you guys can see, I'll figure out, I'll send you guys something because I see a lot of you are interested in that. Okay, step 5. Submitting your offer. So we decided what the maximum purchase price is. If you were going to live in it, it was $150,000. If it was an investment, it was $100,000 in that example. So we want to submit the offer. So that's where you would shoot, if you're working with me as a loan officer or whoever your loan officer is, you would shoot them the details. Hey, here's the property address, the purchase price, the renovation budget, and just have them run the numbers, make sure it looks good, and give you a pre-approval letter that's customized to the offer that you're making. Oftentimes we want to discuss the financing with the listing agent up front, because if they're not familiar with renovation loans or they're not necessarily marketing the property as that, it may make them nervous to get the offer without having, knowledge of that up front. So on deals I do, I usually call the listing agent and I let them know either, we're about to submit an offer or you just got an offer and I just wanted to discuss with you renovation loans, make sure you're familiar with them, see if you have any questions, let you know that me and my team and my company are experienced with them. So really you're just kind of putting the listing agent's mind at ease so they feel comfortable with the renovation loan, because renovation loans do have a bad reputation. And a lot of agents, they get that offer and they really don't even want to look at it. They're like, no, cash only. We don't want to deal with this. We don't want to deal with this. And they're not bad loans, but you have to have a good loan officer and a good lender that's experienced with this. A lot of companies say they offer renovation loans, but they're not very experienced at it. They are, it's not one of their specific niche products that they work on, having a good system for. And so it kind of becomes a disaster, and that's how they get a bad reputation. So if you're doing something specific, niche-y like renovation loans, you really want to work with a renovation loan officer and a lender. So the company they work for and the specific loan officer that's very knowledgeable about this product. So those are pieces that will help with the offer, is letting the listing agent know, that you have a good loan officer, you have a good lender that's familiar with these, they can get them done. That'll help them sell it to their seller. Mortgage contingency terms. So first you have the loan type. You want to definitely put in the offer the loan type. So if it's an FHA 203K, put that on there. If it's a conventional home style, put that in there, write it in the offer. The loan amount. So a lot of the contract templates say the loan amount is a certain percentage of the purchase price. So say if you're doing a 5% down payment, your loan is 95% of the purchase price. Well, on a renovation deal, it's really a percentage of the purchase price and the renovation budget. I know there isn't often a lot of room to actually write that in there or, add it with the DocuSign. I mean, if you can, so you're saying, okay, the loan is 95% of the purchase price and then add in and renovation budget, that's helpful. If you can't, just make sure that when it's in attorney review, the attorney modifies the terms so that the buyer is protected for the actual loan amount. Interest rates, you want to consult with the loan officer. Like other loans, they're always changing with the market. They do tend to run a little higher than regular loans though, so you want to check on any given day specific to your client based on their credit score, down payment, which loan, all those factors affect the interest rate. And then of course you're going to negotiate and hopefully agree to terms of the contract. Once you're under contract, we're going to get started with the mortgage application. All the normal steps, pay stubs, bank statements, all of that. You're going to do your attorney review like normal, your home inspection like normal. If it's a larger project and you need a HUD consultant, you're going to get that started right away. Again, if it's larger project or structural work, there are some other caveats of specific type of work that requires HUD consultants, like landscaping. I don't understand that, but if you're throwing landscaping in, even if it's only $10,000, it needs a HUD consultant. So all of that sort of happens simultaneously, getting the ball rolling on that. Then we're going to start looking at contractors. You're going to have to select a qualified contractor to come out and give you a proposal for the job. The common vernacular is bid the job. So we're going to have contractors bid the job. I typically recommend having 3 contractors. It's not required, but it's just good business practice to get some competing bids to make sure you're getting a fair price and talk to different contractors to get different ideas and make sure it sounds like they're knowledgeable, they know what they're talking about. So you don't have to, if you already have a relationship with a contractor, you already know who you're going to hire, you can just have that one contractor. That's fine. But we do recommend 3. Here are the requirements for contractors. First of all, that they will agree to work with a renovation loan. Some contractors don't want to. They don't want to deal with the extra paperwork, the inspections, waiting to get their draws until after the inspections. Some of them just won't do it. So you want to first tell them that up front. This is a deal that's being financed by a renovation loan. Are you okay working with the bank and the paperwork needed? They do need their general contractor license. And as a caveat, I say if required, because that's basically based on the town. So we follow the town's rules. So City of Chicago requires you to be licensed. We require you to be licensed. Some of the suburbs don't require licensing. We don't require it for those either. I would say at least about half of them do require it. And so if the town requires it, we also require it. They have to be properly insured, business liability insurance. Workman's comp is, again, only if applicable. Basically, if they have employees, the state of Illinois requires them to have workman's comp. But a lot of contractors, it's just one guy, and then they have subcontractors. So there's no employees. So if there's no employees, workman's comp isn't required. If there are employees, then they have to have workman's comp, and we need to prove that. Again, the contractor has to be willing to accept the draws on our schedule. We're going to give them the payments, after our inspections, and we determine that schedule. They have to be willing to complete paperwork. There's a package in the beginning that asks a lot of questions about how long they've been in business. Have they ever had any lawsuits? It asks for 3 references of recent clients that have done similar type jobs. So if you're doing a full gut rehab, he can't give me someone he just did a bathroom rehab. It has to be a similar type job, and 3 in the last year. And then so we call those clients and we ask them, did they do a good job? Were you satisfied with the work? Were they professional? Did they finish on time? Did they finish on budget? So we're going to do a little bit of screening. So they have to give us those references and paperwork, and we're going to do some due diligence to validate them. Now, we don't have like an approval list. You don't have to pick a contractor we give you. You can work with any contractor as long as they're willing to go through this process and they pass that validation phase where, you know, their references, you know, speak highly of them, and they, you know, they don't have anything crazy like 20 lawsuits that they've had or anything like that. So when you invite the contractors out, you want to give them deadlines for when the proposal is due. If you don't give them a deadline, sometimes it can take a long time for them to get those proposals back, especially if they're busy. So, you know, you need to tell them, hey, we're on a certain time frame, we're closing on this day, we really need all the bids back by this day. Can you commit to that? You know, and if not, don't even invite them out, because they're just going to waste your time and you're going to sit around for weeks waiting for them. So really hold their feet to the fire, because a lot of contractors are great with hammers and they're not great with pens. So you really need to like give them that deadline and really stay on them about that. So once you get all the bids, you're going to decide who to hire. So this again is based on who you feel comfortable with. Obviously, you'll compare the cost. You don't necessarily want to go with the lowest cost guy though, because you do get what you pay for. And sometimes they're a lower cost because, you know, they cut corners, they're not doing a good job. They, you know, whatever the case is, sometimes they'll come in at a low bid and then they'll try to say, oh, well, it ended up costing more, and try to charge it back to you. Well, when you do loans with banks, that's not how it works. You don't just add money in. What they agree to and sign that they're going to do the job for that price, that's what they have to do it for. So you just want to make sure, you know, you're picking someone good, because this is the biggest risk, is hiring a contractor who's not going to follow through, who's not going to do a good job. The project's going to last too long. They're not going to do it to good quality. So you really want to do your due diligence and hire someone good. You can look on online reviews, like Angie's List is, if you're not familiar with it, it's basically the Yelp of contractor services. And those are all, you know, like regular buyers, just like Yelp. So you're going to get the good, the bad, the ugly. Obviously, the more reviews they have, the more likely it's not going to be just like their 3 cousins that did them a favor and wrote a review. You can look at Better Business Bureau, just general, you know, Google them, things like that. But you want to do some due diligence and try to get a contractor that is trustworthy. Because again, even if they have the lowest bid up front, if they drag the project on an extra 6 months, they're going to end up costing you more than they saved by having the lowest bid. Okay. Okay. So after, at the end here, we were picking the contractor. Once you pick the contractor, you want to finalize the bid, because sometimes there's a little back and forth that you want to tweak it, or, you know, okay, we want to add one thing or take something out, switch it. Contractor deadline, so true. Has one deal that almost died because the contractor bids set expectations up front. Thank you, Ms. Cass. Yes, yes, yes. Okay, so we want to finalize the contractor bid. If you're doing any layout changes, we want to get some preliminary drawings. These do not need to be full architect drawings. They can be just rough sketches. They can be done by an architect. They can be done by the HUD consultant, the contractor. In some cases, I've had clients do it themselves. It doesn't need to be professional. We're not doing like all the technical stuff the architect does. We're just showing the layout. Where is there a wall? You want it to be roughly to scale, but it has to be good enough that when the appraiser looks at it, they know what the house is going to look like when it's done. You know, they need to know, is this bedroom 12 by 12 or 8 by 8? Are there 3 bedrooms? Are there 2 bedrooms? You know, they need to have the rough idea of what's actually going to be done, what the house is going to look like. Finally, we order the appraisal. So on a regular purchase, I'm sure you're all aware that you order the appraisal in the beginning, right after you go under contract. In this case, because the appraisal is based on the after repaired value, you cannot order the appraisal until you know what the renovation plans are, because the appraiser needs that. So we're going to give the appraiser either the contractor's bid or the HUD consultant's report if it's a larger project. And so the appraiser is going to go through in great detail, looking at what does the project look like, again, if there's any layout changes, what the drawing looks like, what are the finishes, again, is it granite countertops or Formica countertops, you know, Is it, you know, cheap off the rack kitchen cabinets, or like custom, you know, the really tall ones? I forget how many inches off the top of my head, but you know, they're going to look at all those details, and that's going to factor into the comps they pick. If you're doing rental quality renovation, they're going to pick comps that have rental quality finishes. If you're doing high-end finishes, they're going to pick comps that have high-end finishes. So they need to know that before they can do the appraisal. So at this point, we order the appraisal because we have all this information enough to give the appraiser. So the appraisal will come in, and we have a couple of questions. One, is the after repaired value sufficient? So hopefully if you guys did your due diligence on your CMA and coming up with the estimated value up front, hopefully we're, you know, in a similar range to what you anticipated. So we need to know that after repaired value is sufficient, and we need to know, do the renovations meet the HUD requirements? So if it's an FHA loan, all that health and safety stuff. Did they find some extra peeling paint, you know, behind the garage that you guys didn't look at that they're saying now needs to be done? It wasn't included. So if there are extra things that that were not met in the health and safety inspection, you just go ahead and add it to the bid, and we tweak things, and that's not a problem. But by the end of the renovation, the property does need to meet HUD standards for health and safety. All right, so obviously, at the same time as this, we're also working on the regular loan stuff, the pay stubs, the bank statements, you know, all of that. We get it all together, we get the final approval, and we close. So then we move on to after closing. So after closing, we is when the renovation begins. Okay, so obviously we have to close first. Everything begins after closing. We do give, and I think most lenders who do renovation loans give an initial draw at closing. So the contractor has some money in hand to start buying materials and the things they need to do to get the project off the ground. It used to be that some lenders didn't give an initial draw. They had to get through phase one, and they got paid after phase one. But I think most lenders, and definitely my company right now, we do give an initial draw for them to begin the work. As the work goes on, the inspections are done periodically. And again, if it's a larger project with a HUD consultant, the HUD consultant is the one that determines when the inspections are done. And it's usually not a time frame so much as a project-based thing. So if phase one is like demolition, for instance, when they're done with demolition, they do that first inspection. And sometimes they like to do that up front because demolition is quick. And after phase one, they can get another check in their hand so they can start buying materials. So sometimes it's as easy as that. So sometimes it's like phase one is all the plumbing, or phase two, whatever. But it's based on the project. It's not so much a time frame. It's not like you'll have an inspection at 1.5 month mile mark. It's the mile mark based on how quickly the project is moving. So the inspections will occur. After each inspection, the HUD consultant signs off that he is satisfied with the work, that it meets the plans that were done and it was done to good quality. You, as the person who owns the home, will also sign off that you're satisfied with it, and the contractor signs off. So everyone has to be on the same page that we're all satisfied with the work being done at each phase. And then the paperwork for that is submitted, where you guys have all signed off on that. The inspection is submitted, and then we release the portion of the money that goes along with that part of the project. And the draws are actually cut to the client and the contractor. So you both have to sign those as well. If something unexpected comes up and you need to do a change order, you can submit those throughout the process. Once everything is done, we do a final inspection. We get the lien waivers, we get all the title releases, all this administrative stuff that we do at the end to close out the project. Then the project is done. You can move in if you're living in it. You can rent it if you're renting it. If you're reselling it, you can list it at that point. So everything is closed there. All right, any questions before we move on to the specific different loan options? Nope, nothing new in the chat. Okay, cool. All right, renovation loan options. So there are a few different options. The most well-known is the FHA 203K. So this is, again, a 30-year fixed rate loan. So most people don't keep it for 30 years, but if you did, the interest rate would never change. The monthly mortgage portion of the payment will not change. FHA loans must be owner occupied. So this one does not work for investors. The down payment on these is 3.5%. Unfortunately, there are not any down payment assistance programs that I am aware of that will allow renovation loans. So typically you have to come up with the 3.5% yourself. It can be your own savings. It can be gift from family. It can be a loan from your retirement account. It can be your income tax refund that's coming up in a few months. So any of those sources, but usually the down payment assistance programs do not work with the renovation loans. The FHA 203K works on 1 to 4 unit properties. So 1 unit property would be a single family house, a townhouse. It is not allowed on condos, and townhouses sometimes are legally condos. So if it's a townhouse that's legally a condo, that also would not be allowed. In the case of 3 or 4 unit properties, not 2 unit properties, but 3 or 4 unit properties, it must meet the self-sufficiency test and have an additional 3 months reserves. So reserves is basically emergency funds that you have left in the bank after closing. So if you need to spend, $10,000 at closing and the monthly payment is $2,000, we need 3 months of $2,000 is $6,000. So you need to show you have $16,000 in the bank. $10,000 to close and $6,000 for emergency savings. It doesn't always have to be liquid though. Sometimes retirement accounts or investment accounts can count toward that. But this again is only for 3 and 4 unit properties, not 1 or 2 unit properties. And self-sufficiency, I'll briefly explain that because that confuses people. And this is on the spreadsheet, which is actually the original reason I made the spreadsheet, is to help people analyze self-sufficiency, but then I added all the other factors as well. So basically on 3 and 4 unit properties, the rental income you could collect on the whole building, including the unit you're going to live in. So assume if you moved out of that unit and rented it, the whole building, the rent you could collect, 75% of that rent, not all of it, because we're going to assume 25% will be for vacancy loss, maintenance, things like that. So 75% of the rent you could collect on the whole building, including the unit you're going to live in, needs to be equal to or greater than the monthly payment. So the monthly payment is the mortgage, property taxes, homeowners insurance, PMI, all of that. Again, there's spreadsheets to calculate this, so you don't need to memorize the formula, but just know that that is challenging to meet that requirement, and not all neighborhoods and price points are feasible for that. But if it's 3 or 4, that is required. If you're shopping in a neighborhood where you're having a hard time meeting that, you can go with a 2 unit property and you're totally exempt. You don't have to worry about that at all. And so that does sometimes open up more options if you're having a hard time with the self-sufficiency test. Is there something else I was going to say about that? No, I think that was it. Okay, seller credits. Just like regular FHA loans, we do allow the seller to give the buyer a credit to help with their settlement costs, up to 6% of the purchase price, but not to exceed actual costs. So if actual costs are only 4%, you can't get the full 6%. But if actual costs are 8%, then you're fine. Okay, so 6% of the purchase price is maximum, not to exceed actual costs. If you're not sure, again, consult with your loan officer. They can run a calculation on that. But obviously lower price points, if it's a $100,000 house, your 6% is fine all day long. But if you're looking at a $300,000 house, 6% is $18,000. Your costs are likely not going to be that high. FHA has maximum loan amounts. So you guys can see what they are here, but obviously the more units, the higher it goes. These are lower than conventional. So if you're looking at a higher price point than these, you may want to stick with the conventional, which we will talk about next. Oh, actually, no, first we'll talk about, I briefly mentioned this before, limited 203K, which used to be called Streamline, basically means it's under $35,000, but under $35,000, including the hard and soft costs, right? So if the soft costs are going to be $4,000 or $5,000, the hard cost, the labor and materials, should be under about $30,000. So this can be done for any non-structural repairs, gutters, HVAC, plumbing, electric, flooring, paint, appliances, accessibility issues. I've seen people do that where they had handicaps and they needed to make the house accessible. Standard 203K, there's not a specific cap to the renovation amount. So it can include really anything, almost anything. There's very few limitations, and it can also include structural items. So if there's foundation issues or you want to build additions, structural things are fine with the standard. Okay, home style renovation loan. This is a conventional loan. And people are often unsure of which one to use. Well, the good news is that you don't need to decide. If you're working with a good loan officer, they'll recommend to you, because it'll be the answer to which loan is best will depend on your situation. The answer is not the same for two different people, depending on the property type you're looking at, your credit score, how much money you have for a down payment. Sometimes an FHA is better, sometimes a conventional is better. Just like non-renovation loans, if you go get pre-approved, sometimes some people will get recommended FHA, some will get recommended conventional. Renovation is the exact same. So home style renovation loan is just the conventional version of the FHA loan. So as far as the renovation process, everything is the same. Nothing changes with the renovation stuff. The stuff that changes is the same stuff that changes with FHA versus conventional. Different down payments, different credit score requirements, different debt to income ratio allowable. So all those factors are the differences. This is also a 30-year fixed rate mortgage. So again, people tend to refinance after, but if you don't, you're protected. There's no risk there. Minimum down payment requirements. So this varies depending on occupancy and property type. So owner occupied, if you're going to live in the property, in some cases you can do a 3% down payment. So this would be a single family house, a condo, or a townhome. And yes, this loan does work on condos, whereas the FHA does not allow condos. So 3%, you have to either be a first-time home buyer, or your income has to be, well, your qualifying income, which is a caveat because you don't have to use all of your income to qualify. So your qualifying income needs to be under 80% of the area median income. So that's different depending on what area you're in. Chicago, I believe 80% is around $71,000 gross annually. So if your income is under $71,000 or you're a first-time home buyer, if you're a first-time home buyer, there is no income cap for that. You can do 3% down payment. Otherwise, if neither of those are true, you have to do 5%, which is still very reasonable. Oh, and one other thing too that I didn't mention, on renovation loans, the down payment is based on the total acquisition cost. So it's not just the purchase price, it's the purchase price, hard renovation costs, soft renovation costs, you add all of that up, then you take your down payment based on the total of that. Okay, if you're doing a 2-unit building, your down payment is 15%. If you're doing a 3 or 4 unit building, your down payment is 25%. Non-owner occupied. So these are real estate investors. So again, FHA did not allow real estate investors, but home style does allow investors with these caveats. So it only allows single family homes, condos, and townhomes. It does not allow 2 to 4 unit, multi-unit buildings for this program. So the minimum down payment is 15% for investors. And again, 2 to 4 unit properties, not allowed. Seller credits are allowable, again, based on regular conventional guidelines. So if your down payment's less than 10%, you can only do 3% seller credit, again, not to exceed actual costs. If your down payment's more than 10%, you can go up to 6% seller credit. So again, those are not different than the regular mortgage guidelines. Just because it's renovation. Here we have the maximum loan limits for, again, 2020. These change every year for Cook County, and they do change some by counties too. If you're looking in other counties or, you know, some people in Indiana, Michigan, those numbers are different per each area. But what you can see is that the conventional loan limits are substantially higher than the FHA loan limits. So again, when we're comparing FHA versus conventional, if you want to be in a higher price point, then that may be one reason to lean toward conventional, because you can get a higher loan amount. VA renovation, I'm not going to really go into detail about this, mostly because there's just not a lot of veterans in the Chicagoland area. So if someone is interested, you know, they can see, but basically the benefits is it's 0% down payment like other VA loans. It only allows the limited or streamlined, so up to $35,000 renovation, and they have a ton of additional restrictions like most VA loans do. So if anyone's interested in that, we could talk about that offline. But yeah, there's not a lot of veterans in the area, so we don't do a lot of this loan in the Chicagoland area. We have branches in other parts of the country where there's, bases and whatnot, military bases where they do a lot more of that. There are some other renovation financing options that you might want to consider on a case by case, depending on the situation. So for instance, if there's only a small minimal thing that needs to be done, you don't want to do a full renovation loan. On occasion, there's something called a repair escrow that can get approved. Sometimes you can take equity out of other properties. If you've got other properties, you can either do cash out refinances or set up home equity lines of credit to pull equity out of those properties to use for the renovation. You can get some non-real estate related loans, like just a regular personal loan, an unsecured personal loan. You could take loans against your retirement accounts. So renovation does not always have to be financed by the property, by any real estate or the property that you're doing the renovation on. In some cases, people can just reduce their down payment. So let's say they were planning to do a 20% down payment, but they want to do some renovation. Well, if they reduce their down payment to 10% or 5%, now they have another 10 or 15% of their own money that they're not spending on renovation, or not spending on the down payment, that they can use for renovation. So that's a good option. Construction of permanent loans, I'm not going to talk about today, but it's basically ground up construction. If you buy a lot and you build a house, we have some loans for that. Hard money and private loans. So hard money are great options for situations that don't fall into what we just described. So hard money in general typically has higher interest rates, higher fees. It's just a more expensive loan. But if for some reason you either don't qualify for these loans, or whatever the situation is, you need to move quicker, you need to be able to close in 2 weeks, hard money definitely serves a purpose. But obviously if the fees are higher, you need a higher profit margin to make that work. That typically only works with investors. Hard money lenders don't work with people who are going to live in the property. Private loans, that would basically just be like, your rich uncle or someone who wants to invest with you. They can give you loans on the deal. One other loan type I wanted to mention is jumbo price point renovation loan. So if your renovation, usually this is single family owner occupied, not so much for investors, but if your price point is over $510,000 for the loan, not just the purchase price or acquisition cost, there are some lenders that have renovation loans that are very similar to the 203K and home style, but they're portfolio products that are at that higher price point. So that is an option as well. All right, any other questions? You can either throw in the chat box or unmute yourself if you want to throw some additional questions. Anyone? Did I put you guys to sleep? Nobody's saying anything. Are you laughing at me, Miss Cass? Okay, well, if there's no questions, I guess I covered everything. Oh, here we go, a question. When you go over the conventional loan limit, I can go back to that page. So conventional loan limits for a 1-unit property, so a house, a condo, or a townhome is $510,000. What happens to the down payment required? So basically, if you want to stick with a conventional loan, you basically just need to increase your down payment to get to the difference. So let's say you were planning to do a 10% down payment. So if you were buying a roughly, just because I'm doing this off the top of my head, a $560,000 property or $560,000 acquisition cost, purchase and rehab, and you want a 10% down payment, that's roughly, well, I guess I'm doing it wrong in my head, but let's say if it's roughly $50,000, it would be like $56,000. You would end up under this $510,000. But you're saying, what if you want to do a 10% down payment, but you want to buy a $600,000 property? So a $60,000 down payment or 10% is only going to get you to $540,000, and you're over this $510,000 maximum loan amount. Basically, you have to bring the difference. You have to bring that extra $30,000. So anything over, if your acquisition is over $510,000, your down payment needs to be at least that acquisition cost minus $510,000. You have to at least get the loan down to $510,000. For HUD consultants, is this provided by the lender or the client has to find one themselves? Most lenders have preferred HUD consultants they like to work with that we recommend to you guys, but you're not obligated to. You can pick any you want. There's I would say at least a dozen. It's not, I mean, it's not like there's hundreds of them. It's not like home inspectors. So there's a limited supply. But yeah, if you have someone that you prefer, you can use them. You obviously just want to make sure that they are knowledgeable, because you want to make sure they're giving you the right, budget and recommendations, and the inspections are good. Acquisition is, yes, purchase and rehab, but again, both the hard costs and the soft costs of the rehab. So all of that together. So as an example, if your purchase price is, let's say 200,000, and your renovation costs are 200,000. So together, all of that is 400,000. That is now your acquisition cost is 400,000. And then again, your down payment is based on that. So let's say you're doing a 5% down payment on a $400,000 acquisition cost, you have a 20%, $20,000 down payment. Oh, one other thing I was going to mention earlier too, with the multi-unit properties that have that self-sufficiency rule. Well, actually, not even just that. Any property where you're going to have rental income. The rental income on renovation loans is based on what you will be able to rent it for after it's fixed up, not current rent. So if you're going to do a really high-end renovation and that's going to increase how much you can rent it for, we can use that higher rental amount. So any property that'll have rental income, you can use that. Any other questions? Are you guys not able to unmute? Is that why you're chatting instead of speaking? You're welcome, Bill. All right, so I think when you guys registered, it captured your email addresses, maybe. So if Nick wants to send that to me, I will try to modify my spreadsheet so that it takes out that custom part to the client with the debt to income ratio. So you guys can have like a general one that you can use to assess properties.
Hey, Marla.
Hey, Cassandra.
There are a couple of questions that are in the chat if you want me to read those or if you want to pop in.
Oh, there's a couple more. Okay, you start paying the mortgage when you close. Okay, so if the mortgage payments are not rolled in the loan, it's the same as a regular mortgage, which means that you skip the first month. So if you were closing right now today in October, there is no November payment and your first payment is December 1st. But if you're rolling the mortgage payments into the loan, then it starts from there. So it would still start from December 1st in that example. But if we're rolling 3 mortgage payments in, that's December, January, February, then your first payment is March. I do recommend budgeting in case it takes longer than expected, that you have to start making that next payment and and the project isn't quite done, that you have some savings for that. Or is it after the renovations you begin in the mortgage payments? So yeah, the mortgage payments start right away, whether they're rolled into the loan or you're paying them yourself, they do start right away. But like I said, skip that first month like all mortgages do. Were there other questions that I missed, Cassandra?
Nope,
Hey,
I think, uh-oh.
Oh, no, I do have a question. It's Ursula.
Hey, Ursula, how are you?
I'm good. How are you?
Good.
The FHL loan, am I doing this right? The 3OK or the home style renovation. Do any of those cover if you want to do a green renovation? So adding like a solar to your roof or anything like that? Or is there a specific different loan that would cover that stuff?
So both. So you can include green stuff in just the regular renovation budget. You don't have to do something special, but there are energy efficient, I think they're called energy efficient, forget exactly what they're called, but there are options where you can do a separate thing. But the only benefit of that is to go over the allowable loan amount. So basically, if you're at the maximum loan amount and you want to add more, if it's energy efficient, they allow you this extra amount. But if you're not at the maximum, there's no specific benefit to using the energy efficient program rather than just regular renovation. And there are some difficulties with it. So for one thing, you have to do, what's it called? It's been a while since I did one of these. The energy, it's like an energy inspection where someone comes out and they do an inspection on the house and they give a rating for how much energy you're gonna save with the energy improvements, and then that somehow affects how much money you can get based on how much you're going to save, because they have to make sure that the costs you're spending, you're going to recover those in a certain time frame. So
Got it.
there's
Okay,
extra steps
thank
for
you
that,
so
and
much.
that inspection has a fee for it too, so you're paying more for that too. So yeah, unless you're at the maximum, the one time I tried to do it was a pain and probably not worth it.
Got it.
Energy
Thank
efficient,
you.
just the regular. You're welcome.
Hey,
So,
Marla, this is Cassandra. Really quickly, can you
wait,
talk
hold
about
on. Who's talking? I'm trying to flip down to see who am I talking to.
this, Cassandra?
Oh, it's Cassandra again. Okay. Hey.
Hey, I just wanted to call out. So when you are thinking about rolling the mortgage into the loan, isn't that something that needs to be told to the loan officer or lender up front or towards the beginning of the loan? Because I had a situation where I had someone who tried to change that in the middle of a loan and
Yeah.
told
Oh, yeah.
no.
So it's definitely way better to start in the beginning of the process. Yeah, if you're going to switch everything, it changes everything. But there is some cases where it's okay. So if you're trying initially to do a regular FHA loan and the appraisal comes back that the property does not meet the health and safety inspection and there's a list of repairs that are needed, you can flip it to an FHA 203K loan just to do those repairs, and you don't need to get a new appraisal or anything because that appraisal already is contingent on those things. They've already listed them. So if it's just those things and we're not adding a bunch of extra optional stuff, it's actually pretty easy to flip it. But anything else, if they want to add a bunch of stuff, then they need a new appraisal based on after repaired value, and there's all these additional steps. So yeah, we don't recommend it. We recommend starting with it in the beginning. It makes things much easier.
Okay, and I was also referring to the question that came up about if someone wants to roll those next few months into the body of the loan, that is something that should be told to a lender up front. Like you can't say, I don't want to roll 3 months mortgage payments into the loan and then towards the middle or towards the end, then you turn around and you say, well, it would be nice if I could do that, because that's really, that's not going to be approved.
Right. So basically, every time you change the budget, it adds complications. So the more you're clear about what you want up front, the better it is. But truly the question about how many mortgage payments get rolled in is really actually up to the HUD consultant, because it's based on the habitability. If the house is not habitable for 3 months, then we're going to roll 3 mortgage payments in. But let's say you're just doing, some minor work or exterior work and the house is still habitable, then you don't necessarily need the mortgage payments covered for the duration of the whole work. So the HUD consultant is really the main one who makes that decision. But if the client has a preference, they should state their preference to the HUD consultant so they make sure their report comes out in line with what they want.
Thank you.
One more question in the chat. For non-rehab conventional loans, is the down payment for 3 or 4 units still 25%? I believe it might be 20% with one of the, let me look it up real quick because I always confuse this in my head and I want to make sure I'm giving you accurate information. So Freddie Mac purchase, owner occupied, 3 to 4 unit, yeah, allows 20% down payment. Yeah, and then Fannie Mae requires 25%. So that's why I always look at Fannie Mae and Freddie Mac, because sometimes there's nuances why one is more favorable than the other. So yeah, 20% is an option for 3 to 4 unit for conventional loans for non-renovation. But the home style loan is a Fannie Mae loan. So that's why they stick with the 25%. Anyone else out there? Hello, hello. If anyone's thinking of a question that they think it's a dumb question, it's probably not a dumb question because probably other people have it too. So just go ahead and say it. All right. Well, if you guys really don't have anything else, you guys know where to reach me if you think of other things, or if you have some buyers that are interested in getting their pre-approval customized to a renovation loan. Let me know. And like I said, I'll try to put together a more general worksheet that you guys can use that isn't specifically customized to each individual client. All right, I guess that's it. Nick, are you still there? Did you want to wrap it up, say any goodbyes? I don't know if you're still on. Guess not. He's probably out doing showings. All right, well, thanks everyone on behalf of myself and Exit Strategy. Thanks for joining us, and we'll see you guys at the next one. Keep your eye out. I think Nick is planning some more, and then I'm also planning some more upcoming. Like I said, one about specific investor, how to calculate the numbers on investor deals. Yeah, and some more coming up. So keep your eyes out for that, and we will let you know when more is coming. All right, have a good night, guys. Welcome.